I will give you the most important taxes that any person who is starting a business should be able to know. Okay. So number one, we have got what we call, when you register a company, today, you register a company today, and you get the PIN, there is one automatic tax that you must be able to pay. It is called income tax. Now, income tax is a tax that is charged on your profits. So you take your total sales and then total expenditures, the difference, and then once you've done that difference, then that profit, that amount here, we call it profit. We take 30% of it, and then you pay it as what? As income tax. There are certain complexities in calculations of the correct amount of the income tax, which is more deep. I may not be able to get into that, but for a normal business hustler that is there, you have to start by paying what we call income tax. It is normally paid once in a year. It is once in a year, and it is also being returned once in a year.
At what time of the year?
At every time. We normally close the year. Most of the businesses have got different timelines for closing their financial year. But once you've closed your financial year, that one that you've declared in the iTax, the government gives you 6 months to be able to file that tax. Now, let me give you a conventional example. Most businesses have got their financial years starting from January to December. So once you finished the December, then the government gives you now 6 months after the December.
So you have up to June.
You have up to June to be able to clear and return all the taxes. Now you understand why people normally return in June, and where the June is always a very important date. Yes, that is the first one. Number two, you are a business, you are having employees. You must be able to subscribe to what we call pay as you earn tax, which is always being done on monthly basis, and the date is always 9th. When you are returning the pay as you earn taxes, it must be done as early as 8th up to 9th. Now there is something that I need to tell the business owners, which many people do not know. That when you are doing you could be having a small company, and the people that you've employed do not earn that much, which reaches the threshold to start now paying the taxes. That one does not mean that you should not return. You understand? You just return. Somebody is being paid 15,000. 15,000, you pay zero pay. You get it? But you must be able to take the information of that person to the system to show that you paid a salary worth that much. In the system, it will calculate, and then once it has calculated, it is going to show that you're supposed to pay zero pay, but you've returned. So that by end of June, when you're going to do now the total, you at some point you're going to indicate in your expenditure that you paid taxes. You paid the salaries on an amount of maybe 150,000. You see, KRA is going to ask you one simple question. You are not registered for pay. How did you pay salaries and wages? You get it. So that's when you get.
Before you only go far, there's something that comes to my mind.
Yes.
I'm thinking about a scenario where you said what is being taxed is the total income minus the expenditures.
Yes.
So part of these expenditures, is it only what someone has spent on buying goods for the company, or also salaries and rents are included?
Yes. You see, when you talk about expenditures, there is a difference between expenditures and the cost of goods sold or direct purchases. You see, for instance, let me give you a conventional example. You are dealing in, let's say, putting up houses. Or let me know, that one is going to be more complex. Let me say that your work is simply to get clothes or eggs from the market, and then once you've gotten them from the market, you come and break them and fry them and now sell them, right? So when you go to the market, you purchase the eggs. That figure, the amount that you use in purchasing, that's a direct cost. We call it direct cost. So it is falling under purchases. You get it? Purchases. So when you are doing your calculation, you start by total sales. You remove the purchases first of all. Once you remove the purchases, then whatever remains, we call it now gross profit. Now this gross profit, now start now removing the expenditures. What are some of the expenditures now? Your rent is an expenditure. Salaries and wages are expenditures. You have got maybe your transport is an expenditure. Fuel is an expenditure.
How about my own rent? Does it count?
Okay.
Because I can't work for that business for free. I need a place to live.
that part of the rent of the directors.
Or even salary. As in also I have.
Even your salary is an expenditure.
It also has to be there.
Yeah, it has to be there. Because if you don't put it there, then there is how you're going to pay it for it later.
Yeah.
Yes, if you do not pay. So your whatever you spend, if at all in your what we call in your policies as an organization, that your rent and plus all the expenditures surrounding the directors, there is how they're supposed to be accounted for in the organization. But then there is also how they affect the tax computation, which is a bit complex. But yes, they are expenditures. I can be able to say yes, they are expenditures,
and they
should be included there.
Okay.
Yes, they should be included there. So when we look at that, when you've done all that, now the remaining figure is what you now do 30% of it, and then now pay as tax. But again, like I told you, there are certain complexities that surrounds the computation of the taxes, which you may not be able. If I start telling you now, you may not be able to start perceiving it well, because there is what we call allowable expenditures and disallowable expenditures.
And when you can tell us the examples. You know, somebody is watching and they need proper clarification on what is happening.
You see now, when we talk about, let me just give it as an also a bracket, explanation. You know, every business, the KRA has given, under Schedule 11, KRA has given what we call these expenditures. When you spend them in the business, we will allow you to remove them, and then we tax what is remaining. We call them allowable expenditures. And then there are certain expenditures that KRA says that one, we cannot be able to allow you to remove it. We are going to take it back and then now calculate the total and then give us part of it as tax.
Okay.
You get it? And there are so many of them that have been put under that schedule in the Income Tax Act. You get it? So you can be able to say all these are allowable, these are unallowable. So when it comes to a point that I'm going to teach tax specifically, then I can be able to list this is allowable expense, this is non-allowable expense, you know. So for instance, you can be able to go for a business trip. That part partly can be an allowable expense. That is, the KRA can allow you to remove that expenditure so that you calculate tax on what is remaining from that sales that you did. And then you can be going on your own vacation. Yes, that is non-allowable. That is, you cannot say that when you were doing the business, I also went for my personal trip, and then refresh, and then you subtract it from the sales.
That's not allowed.
You get, it's not allowable. So you understand the sense of
does
allowable.
not relate to the business.
Exactly. So we have what we call allowable expenditures and non-allowable deductions or expenditures. You get it? So that one is a bit more complex, but those are some of the steps that you take in terms of doing the calculations for the amount of tax you're supposed to be paying. But it's very important, before you make sure that you decide on this tax that I'm supposed to be paying, call on a tax expert to come and assist you in calculating the amount of tax you're supposed to be doing what? You're supposed to be paying. So I've talked about income tax. I've also talked about pay. Let me now talk about VAT. Now VAT is another type of tax which is on every service and every good that has been that you're trading on, with the exceptions of what has been prescribed by the prevailing Finance Act. You get the Finance Act will always come probably after 1 year or 2 years, or depending on the government of the day. They will come and describe and say that we are going to exempt this one, we are going to zero rate this one, then we are going to actually standardize this one, depending on the way the government of the day is. So VAT is 16% on top of that particular service that you are offering. So you are offering a service, you price it at 100 bob. Then that 100 bob, you add 16%, it belongs to the government. It belongs to the government. So that is also a tax that you have to pay. It is being returned on monthly basis, and then it is also done on the 20th of every month. Today, the government has said that every business, I don't know whether you are aware, but the government has said that every business must be on e-teams. Whether you are dealing with VAT or not, you must be on.
So by each and every business, you mean even that guy on border?
Every business, so long as your business is registered.
Or registered.
Yes, so long as your business is registered.
And I understand there are two types of registration.
Yes.
The business name.
Yes.
And then we have now the.
Now we have got several types. We call them forms of businesses. Now forms of businesses, we have got the sole proprietorship, where when you go to the e-citizen, you'll register it as a business name. Then you have got the limited liability company, where now when you go into it, when you register it, it becomes that name, then you add the word limited. And then this partnership, where you go and with limited liability partnership, LLP, when you go to the system, you register it, and then it ends with the limited liability partnership. Then there are several of them, public liability company. We have got several forms of businesses.
So my main interest is that one who was registered
for business.
Even that one is going to be
it's supposed to be on e-teams. Yes. So that when you do business, you invoice through the e-teams, and then the government knows immediately that you've done a business and you've already invoiced, so that you don't cheat them when it comes to the time you're supposed to be calculating your taxes. This time around, mmeshikwa hivi. You cannot escape. So that is the third one, the third type of tax. I've talked about income tax, I've talked about pay, then I've also talked about VAT. Yes. So then there are now other many forms of taxes that might be able to fall there. There are these ones like you want to import, there's excise duty, there's also where you want to, there's what we call now, let me say something. VAT, when you have, for you to register VAT, according to the Finance Act, you have to be actually earning, or your turnover. When we talk about turnover, it's like total sales
at the end of the year.
At the end of the year should be at least 5 million. 5 million. So you see, there are these businesses that their total sales probably are below 5 million. They are still supposed to pay taxes. But then, which type of tax? Now we call it what we call turnover tax. Turnover tax. Now, turnover tax is for the businesses that are having turnover which is less than 5 million. Yes.
And can it also be a limited company?
Yes.
Okay.
It can be a limited
So it can be registered as a limited company,
but
and if it's not able to make 5 million a year, it will file as turnover tax.
But you see now, sorry, I think I should not mislead people there. So long as you're a limited company, then you are going to be doing that what we call income tax, which is supposed to be doing on yearly basis. But at the same time, when you're a limited liability company, yes, but you're dealing with products. You are selling products. For instance, you sell, let's say, these flowers. So you see, when you sell these flowers, but then the turnover is less than 5 million, you can again now register for what we call turnover tax, and then you'll be able to pay this. But before you register for turnover tax, there's what we call presumptive tax. Presumptive tax is a tax based on the amount you are paying for what we call the business permit or county council permit. Yes. So you pay a percentage. It's supposed to be 15% of the county council permit. Then you pay it as a presumptive what? Tax.
So that's the amount I pay at the county council when I'm getting a permit.
No, with the amount you're paying at the county council, you can go now into the system of iTax and register for what we call presumptive tax, whereby you now pay 15% of whatever you paid to the county, you pay the county council. And then once you've done that one, then you proceed with what we call turnover tax. But for somebody who might want maybe more explanation, can still be able to reach at us Ecovest Consultants Limited, so that you can be able to even give you more explanation and more consultancies, on the same. But that is something that is very, very important, that businesses get to know those 4 types of tax. Quite key. Anybody who is in business, get to know these 4 types. Number 1, income tax. Number 2, pay as you earn. Number 3, VAT. Number 4, turnover tax.